Okay, we go on to Unit 18, which is taxes affecting real estate. Here we're talking about city and county property taxes. The taxation process is ad valorem, is based on the value of the home. It's levied for a calendar year, that is from the 1st of January to 31st of December. Is paid in arrears. That means you're paying for the year that you're in up until the end of the year, but we don't actually have to pay it until late in the year. And the rules say that it should be assessed at the just value, which is an objective valuation placed on the property by the tax assessor. And the assessment trim notice is sent out in August. The truth in millage. Here's an example of a trim notice. And basically what they're doing is saying, listen, in August, we're going to send you out what we think your taxes are going to be. This is not a bill, as you can see. And it gives you a chance to look at the taxes to see what they are or what they will be. Give you a date by which you can appeal the taxes and so forth. We talk about that a little bit later on. You can see that the taxes, about 35% of the taxes, I think this is for 2017 in Manatee County, 200 million came from the actual property taxes. We had licenses and permits, intergovernmental, state, federal and local charges for services. And where the money goes, it's out of curiosity, it goes to public safety and physical environment maintenance, general government that pays for salaries and what have you, recreation, capital outlay, others, and that sort of stuff, and public transportation. So that's where the tax money goes, but it's about 35% of it comes from property taxes. We have a property tax schedule. 1st of January the tax year begins, and the lien is attached to your property so that some adjustment has to be made when the home is sold to cater for the taxes that will have to be paid later on in the year. March the 1st is the latest date you can file for your homestead exemption. You have to show that you've been in the home on the January the 1st. You owned the home by January the 1st. April the 1st, last year's taxes. So if this was the 2019, then we'll say you would have to pay your 2018 by April Fool's Day, or they become delinquent. Sometime around August they send out the trim notice. And then sometime in November you have to start paying your taxes. In Manatee County you have to pay the tax bill as a whole. And you do get a reduction in the amount owed if you pay it early. And then the tax year ends December the 31st. I've got a copy of a tax bill here just so you can have a look. Here it'll give you your parcel number and your legal description. There that is. All the different districts will put in their bid for your taxes, and at the end of the day the total bid amount, or rather the total tax amount, would be $828. If you pay it on the 1st of December, you get sort of $33 off, $7.95. If you pay it on the December the 31st, you have to pay $803, but if you wait until the last moment, you've got to pay the full tax bill. So they do give you a little bit of a discount for paying early. Okay, from the trim notice, if you feel the taxes are not correct, you can protest by going and contacting the county property appraiser by the date on the trim notice. You can appeal to the Value Adjustment Board within 25 days that the trim notice was mailed. The Adjustment Board actually consists of 2 county commissioners, 1 school board member, and 2 citizens of the county that aren't connected in any way in the running of the government, local government. Otherwise, you can go to the court and file suit against the property appraiser. And you have to do that within 60 days after the Value Adjustment Board has finished its appeal, its decision. We do have a city, county and school board budgets for each fiscal year, and the property taxes are used to pay for the majority of budgeted local services. We do have properties that can either be immune like government properties are not assessed and not taxed or exempt. They do have assessments, but they're exempt from paying the taxes due on them, like churches, non-profit organizations. So they are subject to taxation, but released from taxes. And we have partially exempt, which is homes that are homesteaded, is what we normally deal with. So they're taxed on only part of the assessed value. To qualify for a homestead exemption, you have to show you're a permanent legal resident in Florida, and you can only claim one homestead address. You have to hold title to the property on January the 1st, legal title, and it has to be your residence, so they do ask you to show driving license and proof of other information that shows you live there. You have to file within between January and March the 1st to claim exemption for that year, otherwise it will just go over to the next year. When you get homestead exemption, you are relieved of being taxed on the first $25,000 of your assessed value for city, county and school board taxes. Then you have to pay the taxes on anything above that, up to $50,000, and then you're exempt another $25,000 for city and county, but not for school board for any properties that are assessed above $75,000. Let's give an example here that's in the book. Home is assessed at $49,000 and is homesteaded. So we do not pay any taxes on the first $25,000 of that assessment. The remaining assessment, which is going to be $49,000 minus $25,000, which is going to be $24,000, will actually be taxable. So you'll be paying tax between $25,000 and $49,000. So what we would do in this case, we would look at our assessed value, we would take off the $25,000 and we'd have a remaining $24,000 taxable value, which we'll pay taxes on school, county and city. Let's look at a more expensive home, $350,000. Same thing applies for the first $25,000. We have to pay taxes on the next $25,000. Then we're relieved taxes only for the city and the county on the next $25,000. And then we have to pay taxes on the remaining. So in this particular case, when we work out exactly what the taxable value is, we would take the $350,000 and just take off the $25,000 for the schools. That gives us a taxable value of $325,000 for the schools. But because we get an additional $25,000 for city and county, then we would end up with a $300,000 taxable value for both. If I go back to our tax bill, you can see this actually kicking in. Here's a tax bill here. It is homesteaded, I believe. And you can see that as we come down here, the exemptions, this assessed value is $84,000. So here are all the county or cities. In fact, this isn't in the city, so we're just looking at the county exemptions here, the first four. We get the $50,000 off. So instead of being taxed on the $84,000 assessed value, we're only taxed on the $34,000 assessed value. But for the three school boards, we're only exempt $25,000. Therefore, we have to pay a little bit more taxes per dollar on the school board districts. All right, let's just move on. Okay, we do have additional exemptions. We get $5,000 extra in addition to the $25,000 and the $50,000 for a surviving spouse, who will get $5,000 of exemption off the assessed value, legally blind, or if you are a non-veteran who is totally and permanently disabled. And also, if you're a disabled veteran of at least 10% disability by military service-connected misfortune, an additional $5,000 exemption from your homesteaded property assessment. Also, totally and permanently disabled veterans and first responders are also totally exempt, and this includes surviving spouses of veterans who die on active duty. And essentially what we do, we have cumulative exemptions. So depending on how many exemptions you get, for instance, for example, the first one here, we have the schools are 25,000, and then you have a blind widow. So that blind widow, she gets 5,000 for each. So the total assessments will be reduced by 35,000. And city and county 50,000 with a widow, then another 5,000, and that will be 55,000. So how we come up with the taxable value is we actually go to assessed value minus exemptions equal the taxable value. Let me just go back and I'll show you that on our tax bill if I can find it. Okay, here's our tax bill, and let me just zoom it up a little bit for you. And you can see here how we have the assessed value and 50, 50, 25. So these are the counties, these are the school. But in the case of a blind widow, for instance, then this would have gone up by 10,000, and these would have gone up by 10,000. Therefore, the taxable value would have come down by 10,000. I hope that explains it clearly enough there. We also have what's called Save Our Homes portability. Save Our Homes and portability. Basically, this is an amendment to the Constitution of Florida, 1992, which says when house prices are going up rapidly, it is unfair for the assessed value and tax value to go up rapidly, because it will make homes hard to be homeowners to pay the taxes on it due to no fault of their own. So it limits the increases of assessed value for homesteads to either 3% or the consumer price index change, whichever is the lesser. So the Save Our Home benefit is market value minus the assessed value, and homeowners may transfer up to 500,000 of their benefits in the 2 years after they sell the home and move to another one. I'll give you an example here. We have two homes identical, except one is homesteaded and the other isn't. This is the home value, this is the assessed value. As the home value goes up, the assessed value also goes up at the same time on the non-homesteaded home. This home is homesteaded. Maybe these were 5% and 5% and something like that. But on the homesteaded home, if the home value sort of went up by 5%, the assessed value can only go up by 3. Next year it goes up by another 5%, but it only goes up by 3 here, or the CPI index, and so forth. So we actually have a disparity between the two homes. In the homesteaded home, we actually have a savings, due to the Save Our Home regulations, of about whatever the difference is between the home value and the assessed value. This is called the SOH, or Save Our Home benefit. That can be up to $500,000. Let's have a look if we were to sell this house and move into a bigger one. So I can see, for instance, that I had, from the question, a $40,000 Save Our Home benefit from the home I just sold, and I want to move into a bigger home, which has got an assessed value of $300,000. So the first thing I would do is I would transport over my $40,000 to this new home. That makes my assessed value now $260,000. If I take off my assessment exemptions for a school, that would bring it down to $235,000, and then I can also take off another for city and county, and I'll pay taxes on the $210,000. So these would be my new taxable values. And that's how the Save Our Home benefit works. Just going to pause that and make a second video to carry on.